we start off, obviously, as always, I'll give a small introduction about the financial summit, and then we can start off, obviously. As you all know, we just had our event in Dubai. It was a great success. I think it was one of the best we have done so far. And it was amazing to have so many like-minded people in the same place in Dubai. Like, what's your feedback been on the Financial Summit event this year?
Oh, the feedback's been great. Everyone that came had an incredible time. It was we still got a bunch of posts to still make here on Twitter and Instagram. And so many people are looking forward to the next one. Everyone always complains why the next one is so far away. But yeah, we need a little bit of a break. We want to regroup. We want to build up a bigger following here on Twitter and Instagram and other social media. I already see a couple of people joining us that attended. We'll try and get them up as speakers. But, my opinion on the event is not like, again, I'm kind of like the founder. So you really want to hear from people that attended, not people that were organizing. So when a few of them come up to the stage today, it would be really cool to get their views on what they got out of it and whether and how they recommend it to others and who they recommend to.
Well, I've been trying to invite Alexander on. Polto is basically in our listeners today, so that would be great to know his point of view as well. But from our perspective, I really enjoyed it, Tone. It was a great summit this year. So many things to learn, from trading strategies to multi-sig wallets to crypto security, to how crypto is behaving, to how the ETFs will be good or bad, and also to understand your analysis on the markets from like ages ago, which you showed us. That was really, really insightful. So I really enjoyed this year. So let's start off, Tone, before we have our guest as well. So I want to start off talking about the stock market today. Number one, Intel is sitting at a 52-week high. Tesla is doing well, pretty well. They are back to their pre-earnings prices. Markets are basically looking really, really good at this point of time. And as you predicted in our last spaces, that you do not see a very deep retracement, and you had certain levels that you talked about. Can you put some light on it? What are you seeing in the markets right now? How you're seeing the markets perform?
Yeah, I remain bullish on the markets. I know we haven't done a lot of these spaces in the last couple of weeks, but I was always looking for a market reversal in October. And it looked like the market reversed in October, like October 2nd to 3rd. And that's always, a little bit concerning because the market reversed and started to rise so early in October. What does that mean? Is it possible that we're going to fall back down and make a lower low within the month of October? And it looks like that's exactly what happened. The market started to rise in early October, then it turned in mid-October, and then it found a low on like the second to last day of October, like October 29th or 28th. The market significantly reversed, and over the last 3 weeks, it's been crazy how high it's gone, and we're on the verge of making a new annual high, and then we're only going to be within 5% of the all-time high that I expect us to break next year.
But to comparing Russell 2000's performance with S&P 2000's performance, S&P 500 performance, sorry, my bad. There is a massive lag in Russell. What do you think it's due to? Like, is there a fundamental reason behind it?
To me, that is the cause of international capital. If you compare all four of the main indices, you have the Dow Jones, you have the Nasdaq 100, you have the S&P 500, and then you have the Russell 2000. If you just put them in order of how many stocks is in each one, so the Dow Jones is the best performer. Then you have Nasdaq 100, then the S&P, and the Russell is just a disaster. And to me, what that means, and again, I'm not going to take full credit for this. I was taught this by reading Martin Armstrong over the last decade, or even almost 2 decades now. I think starting in 2013, I started reading him, or even before that. Yeah, about a decade. And he always stated that when international capital comes in, they don't care about the Russell 2000. They don't care about some company that's number 1,800 on by market cap. They care about the best top performing companies. And they invest their money in the companies that they know, which is mostly the Dow Jones, and then the top tech stocks, and then somewhat the S&P 500. So what we're witnessing now is something that I've known for almost a decade now, that the reason why the US stock market is doing so well while the US economy is kind of shitty, and the US political system and military, everything is like looking like it's terrible, and yet the US stock market is doing so well. And when you look at the Dow Jones versus the Russell, you see a massive gap, and that is international capital coming in. They want to invest in the companies that they know. They want to invest in the famous companies, and people are being dumbfounded. How is the stock market doing so well? But it's top heavy, because if you are European, if you're anywhere outside the US, and everything is bad across the world, especially in Europe, especially in the Middle East with these military situations, and the money is flowing in, and the money is not going to flow into some company, some startup. The money is going to flow in into the companies that everyone knows.
That's valuable. Hey Joe, how are you? It's been a while. We haven't spoken.
Yes. Good afternoon, everyone. Hope if you're in the States.
I hope everyone missed you, and I hope you missed us.
Absolutely.
So we were just talking about the S&P 500 performance, and obviously the Russell 2000 not being so performant. Do you have any insight into that, Joe? Do you have anything to add to that, like in regards of the perform? Like you were on the spaces that Tone basically predicted the price action for S&P 500, and he said that I don't see the price action going much lower, and there was a great bounce over the last week or so. We have had green candles after green candles, a proper uptrend structure coming into play. We are breaking out of the bull flag structure that was created, a kind of skewed one, but still there. What's your insight on it?
Well, I agree with Tone's premise. I think it's probably the single biggest contributing factor, the preference over these mega caps, which dominate the both the Dow, I mean, in form of Apple, and also the S&P 500 and the Nasdaq. And the reason is exactly what he said. Like these things are basically nation states. They have bulletproof balance sheets. I put out a tweet this morning about how, like, effectively their ability and their preference among the investing classes as basically a reserve asset, as good as money, is how they're basically treated. They're bulletproof. It's kind of both a safe haven and it's a place to park your capital for growth. So compared to emerging markets, compared to a lot of weaker players, compared to bonds, they do have sort of that attractiveness about them. The only thing I will say in addition to that is that I think a further complicating factor that I don't think was mentioned, or at least it wasn't mentioned when I joined the room, is the fact of interest rates, right? And you've seen this huge pop. I mean, you had one of the single best performing days of the Russell this year, coincident with the bond market finding a bottom roughly at the end of October, right? And I mean, you saw the regional banks, for example, the KRE ETF, it popped 5% in the day. And small caps have been on a really good run actually recently. So I think one of the reasons why you've seen the S&P and the mega caps run and some of the laggards in the Russell is because of this turmoil in the bond market. Just as basic financing costs, right? If your financing costs increase by virtue of a sell-off in the bond market, by virtue of higher interest rates, that's going to put pressure from a balance sheet perspective on the smaller, weaker players that don't have the ability to borrow with the same sort of attractiveness as Apple, for example. So, the dynamic I think you're seeing in play is that, as the bond markets have stabilized, the Russell has also stabilized. I mean, the Russell actually made a new bear market low, taking out the 2022 low at the end of October, and then almost exactly when the bond markets topped, when the interest rates, yields on treasuries topped, you saw the Russell find a bottom. I don't think that's a coincidence. I mean, I think that is just investors realizing that as interest rates come down, the stress on the weaker, more vulnerable small caps will also come down.
Well, on Tuesday we had the CPI data, guys. We had an employment data coming out as well last week, and 97% of the small caps basically closed green on Tuesday. Now, what sort of indication is this data really giving to the Fed now? Like we have seen them halt rate hikes. Global economy is, according to what I see, is still in a turmoil. I don't think we are basically, yes, stock prices are high, but the conditions are still not eased off. But how do you see this panning out with small caps pumping, Bitcoin pumping, S&P pumping, everything is looking green, 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 but still the world economy is not in a better state. So what's your take on it? Is it like, do we feel that this might be just, a small rally to the top and then back down? Tone, Joe, anyone can step in. I mean,
Oh,
who's ever.
I thought that was for Joe. You want to go first, Joe? If not,
Yeah,
I'll go.
sure. So I don't. I actually think that I expect this bull rally to continue for some time here into the early part of next year. I think that the stabilization in the interest rates, even if they don't come down precipitously through here, you will still see continued strong growth. And the reason for that is that although money is more expensive than previous cycles, right, and previous historical bull runs we've seen, that is different from money being tight. And you're seeing sort of the early indications of green shoots in lending activity. You saw some of that in the recent senior loan officer survey, which, as long as money does not become tight, as long as it's just relatively more expensive, I think that stocks, in particular, risk assets overall, can do generally well. You're still in a secular low unemployment regime right here, where you've seen a little bit of pickup in claims data, but nothing too alarming. And absent some huge exogenous event, some credit event or something which you can't really plan for or anticipate, it'll be one of those things where we wake up and everybody's talking about it, but it was hard to sort of forecast from a trading standpoint. Absent something like that, I don't see a reason in the short run, meaning next 1 to 2 quarters, why this is just going to all roll over. I mean, keep in mind two things. Number one, we printed 8% current dollar GDP growth in the third quarter. 8%. That's ridiculous. That's not just hot from a growth perspective. That's boiling. Like, that's emerging market for the United States in terms of nominal GDP. And they just revised up Atlanta Fed Now GDP Now forecast for Q4. So I'm sorry, but the recessionistas who have been calling this for 2 years, I guarantee you, we will get a recession at some point. There's no doubt about it. But the data is not there currently. And what I expect to have happening is I expect that asset prices to rise from here. I expect there to be a reacceleration across, even some of the weaker players like the Russell. I think it will have a pretty good run moving forward here. And what that effectively does is that reintroduces liquidity, believe it or not. As stocks and bonds rise, as the value of these assets rise, you effectively have an easing of financial conditions. So I expect that inflation will continue to remain sticky, the 3%, moving into the early part of next year. And absent some huge sell-off across asset classes, which I don't see coming, I actually think they're going to have to revisit further hikes and further balance sheet roll-off into the middle of next year. I think the market's got it totally wrong, and the bond market continues to price cuts for March, which make no sense to me. I don't see why they're forecasting that, given some of the data we have.
Yeah, I couldn't agree more. I mean, I've been bullish on the stock market forever, and I've been bearish on the bond market also forever. I see that the Fed doesn't need to raise rates anymore for now, because the inflation is not coming in that hot. Inflation came in lower than expected at 3.2 versus 3.3. It's not great. Inflation numbers are still high, but the interest rate is almost double the rate of inflation. So I think Powell is okay with it. If the stock market is really rallying to an all-time high, then he has, some leeway and some capital to raise the interest rate a little bit more. But also the free market tells him what to do with the interest rate. And the one thing that I found most interesting in the last couple of weeks was a headline that no foreign entity was interested in U.S. long-term debt. That is really, really fitting. And it keeps bothering me every time I hear these politicians say, we're borrowing money from China to, to pay for weapons in Ukraine, to pay for weapons in Israel. I mean, no, you're not borrowing money from China. China has stopped buying U.S. government bonds years ago, and they're selling U.S. government bonds. It's just like, it bothers me. Yes, we're borrowing money to send weapons to these countries, but we're not borrowing it from China. China knows better than to buy U.S. government debt. They know that the U.S. is going to default on their debt, or they're going to eventually there'll be a full loss of faith in the U.S. dollar that's coming. And it's not coming next year, but it's certainly coming within 30 years, and it's probably coming within 10 years. So China wants nothing to do with U.S. government debt, and neither does any other country that understands what's going on. Europe is totally clueless. Japan is pretty clueless. But other than that, countries want to stay away from U.S. government debt. And we've been covering it here on Spaces and on my YouTube channel for a long time. So I see everything playing out exactly as I expected. And I don't see it changing anytime soon. However, there are major elections all around the world coming next year. There is a big election today that I'm really curious about. And maybe we'll have time to cover it a little bit. I don't know if there's any Argentinians here listening to us that could, shed a little bit of light on what's going on there. But these elections can certainly throw a wrench into things. But for now, I think it's business as usual. And the U.S. stock market higher, U.S. bond market struggling because no one wants to buy the debt. And I think commodities are going to rise as well. Jump in there, Joe.
Yeah, I just wanted to add, because I don't think we talked about this in one of the previous spaces, sort of an update. We had this big announcement at the end of October, in form of the quarterly refinancing announcement from Janet Yellen. And as much as everybody's so focused on Powell and the Fed and what they're going to do with short-term interest rates, her decision to basically continue to fund the government primarily with bills over coupons, over longer-term bonds, I think is a huge factor that's going to drive this forward for potentially 2 to 3 more quarters. And I'll explain why. Because ultimately, a ton of supply for long duration bonds sits on the Fed's balance sheet, okay? And they don't actually ever sell that into the open market. QT is not the opposite of QE. What happens with QT is they just let the bonds mature and they don't replace them, but you don't actually get that supply to enter the market. So, you had this influx of new supply of longer dated treasuries coming to the market after July, and that's what caused this sell-off, basically a 10% correction. And Yellen's decision to whether you think it's because she wanted to juice the economy or the stock market before the election or not, it doesn't really matter. The reality is that she's not issuing a significant amount of longer dated paper, which has basically caused this rally in the long end, in my view, because they realize that there's not going to be more supply to absorb. So you have an interesting dynamic here where more of the government is being funded with short-term paper, which is far easier for institutions and individuals to absorb. Just think about it practically. If you wanted to get some interest on your cash, would you rather buy a long-term bond, which has a ton of interest rate volatility and duration risk, or would you rather just buy short-term paper like treasuries, 3 months, 1 years? Why wouldn't you carry the bulk of your money in short term? Because that even if the interest rates move around a lot, you're going to get your money back after a very short period of time. You're going to get it back with interest backed by the U.S. government. So, institutions would much rather hold the short-term paper. And without the sell-off at the long end, I don't think you have as much pressure on risk assets. And that's what we saw. So, that decision where the market expected her to issue a lot more of longer term paper, and her decision not to and sort of kick the can for a few quarters as you go into an election year, I think it's really meaningful, and people are discounting how important that is from a funding and balance sheet perspective.
Wow, perfect. By the way, guys, everyone, if you have any input, if you have any questions, if you have any input on the things that we are talking about, feel free to send a request to join in. We are very open. We are an open space, and we like to invite every one of our people over here to basically put some, to add to anything. So please feel free.
Also, feel free to use that button in the bottom right-hand corner to just like ask your question, and then we'll keep an eye on that as well.
So, moving on, guys, I want to talk a little bit about commodities and then obviously move on to the favorite topic. So, how are you guys seeing the performance of gold, of silver over the last couple of weeks that we have been away? Uh, do you see any sort of market reactions that you are expecting in any one of them? And also, quite curiously, I just want to add, I was looking at the gold BTC chart, Tone, and I was so surprised of the heavy bear market structure that gold is in against BTCs. That was very, very crazy to see.
Well, look, gold is it's not going to outperform Bitcoin. I think gold has an incredibly bullish chart. I think gold is ready for a breakout from 2000 to 3000. That's a 50% rise in gold. For gold, a 50% rise is very, very significant. So I am bullish gold, but it's just not as volatile as Bitcoin. And the last few months, Bitcoin has done really, really well, and gold is just continues to consolidate and getting ready for that major breakout above the $2,000 resistance line. So I am looking forward to a gold breakout. Joe, what are your thoughts on gold? And then we'll get to Surfer Jim's question.
Yeah, I'm not terribly negative on gold. I was short gold earlier in the year. I don't really see any reason why it shouldn't head higher from here, particularly with the easing of financial conditions. And just to step back for a second, I tweeted something here or put it up in the nest. You can take a look at it yourself. It's the Goldman Sachs Financial Conditions Index, and you've seen effectively this huge move of easing of conditions since the end of October. I mean, just look at that, and that indicator that's put together, it has a weighted average of interest rates, long-term interest rates, spreads of credit spreads in general, particularly high risk, and equity prices relative to the 10-year. So basically in a forecast on earnings, and that just shows you. I mean, the market now is night and day difference from even where it was a month ago, and I don't really see that just reversing in the short term. But to the point about gold, I mean, as financial conditions ease, I think you're going to see gold catch a bid here. And the one thing you have, even though I don't like gold, I'd much rather hold Bitcoin or stocks than gold for a variety of reasons. You have to be impressed by the relative strength of gold in an interest rate environment where you have real interest rates. Gold does not tend to do well in rate environments where you have real interest rates. And the fact it's hung in here so long, relatively near the highs, that's very constructive. And I don't know if you can be very bearish on that. Just from my preference, I would much rather hold, probably 10 other assets. I'd rather hold the SMH, the semiconductor ETF, over gold.
So for
Yeah, that's
Jim,
a
your
good point,
question?
Joe.
So sorry about that.
Let
You were
me
saying
just
something?
comment on. I'll just go real quick. That's a good point, Joe. I can see gold struggling in a high interest rate environment. However, a lot of people equate a high interest rate environment being bad for the stock market, and I've always argued against that. The stock market has an average historical return of 8%, and at times where interest rates have been high, the stock market has significantly outperformed the bond market in those years anyway. And that's because people will borrow money at 6-7% and invest it in things where they know they can make a profit, and they will not borrow money at 2% if they have no idea what to do with that money in order to beat a 2% return. So I never equate interest rates with versus stock market. I think it's completely uncorrelated. And however, when it comes to gold, because gold does not gold is just a speculative asset. So it's not like the stock market. So yeah, I can see gold. Gold probably would have broken out massively already if interest rates have not been rising the last year and a half.
So for Jim, you wanna ask your question?
Yeah. Hey guys, thanks, Tone. Thanks for hosting this. You know me for a while now, and I'm not a financial guy, but being in Bitcoin, I've had to pay attention, just to be aware of the markets, what's going on, and it's listening to guys like you and Joe that are that have careers that revolve around this stuff much more than mine, that I get to learn this stuff. So I've been hearing this bond stuff for a while now. I understand that what you said, Tone, about the people don't want to deal with the duration risk of buying long-term treasuries, so they're buying short-term. And I'm just curious if you or Joe have a sense of what does it take for those investors to look closer at Bitcoin? Is it still just too volatile? Would an ETF change their position to move towards Bitcoin as even a short-term store of value? Although I don't think short-term is the way to look at Bitcoin. But I'm just curious, what do you guys see in terms of like the general market of people who are really not plugged into the Bitcoin community? How do they see it? And what's going to cause them to want to use that in their portfolio versus some of the U.S. Treasuries, which anybody who pays attention understands that dollars are worth less. Even if they pay you back the full amount with interest, you're getting it in the future, and it's not going to purchase as much. And so I'm just wondering when that narrative gets through to people, and what's your guys' opinion about the time frame? Like, are we looking at years for this narrative to take hold? Do we need to wait for Bitcoin to get less volatile? It's a very broad question, but I look to guys like you to help me see the bigger picture. So I'm just curious if you guys have an opinion on any of that. Thank you.
Go ahead, Joe.
Yeah, I could talk about this, Jim, and we have at different intervals for hours, right? So you got to start and try to focus on what population of people, what segment of asset holders you're talking about. That's the first discussion. And if you're talking about family offices, if you're talking about individuals, high net worth individuals, ultra high net worth individuals, that's very different than the institutional class. And the good news, the bullish news, is I think Bitcoin can be sent orders of magnitude higher in a relatively short period of time, 5 to 10 years, through just that cohort, just the high net worth individuals, the family offices, even some of the more avant-garde institutions. But to get the big pool of money, the pool of money that sends Bitcoin ripping higher beyond anything most of us can imagine, that's going to take a long time. I think it takes decades. And that's the bad news from your perspective. And there's a real reason for that, because there's an entire regulatory regime, thousands and thousands of pages, Basel. We can go on and on about it. I'll just save you the details of it, from basically understanding the big point, which the big point is there is money trapped in areas where they are forced to hold bonds, okay? High quality liquid assets, of which Bitcoin is specifically excluded from currently under the current regulatory regime. A lot of banks, a lot of multinationals, they have to hold treasuries for two reasons. Number one, liquidity, because they can liquidate billions of dollars worth of treasuries in a day if they need to. You can't, it's very difficult right now. Just think about practically. If Michael Saylor woke up tomorrow and wanted to liquidate his entire Bitcoin holdings, he could do it, but the effect on the price would be dramatic. Right? He's not going to do that because he's a long-term hodler, right? And it's a long-term play for him. But the liquidity is just not there to absorb, billions of dollars of Bitcoin being sold in relative short order. It needs to be there for a lot of the banking institutions and multinationals, and even a lot of the non-banks. So the liquidity is not there for Bitcoin. It needs to get orders of magnitude bigger to absorb that sort of deluge in the event of high volatility, and that's why the regulatory regime requires them to hold, in large part, bonds. Okay, but there's another difference. Okay, the difference between Bitcoin and a lot of the other assets and a lot of the treasury market, and this is true of even equities, right, is that banks and other financial institutions can more easily lend against treasuries, which are understood to be money good. So what does that mean? That means that if the world goes to hell, at least people expect the U.S. government to pay its bills. And that's why a lot of entities, even foreign entities, which I heard Tone make a comment earlier, which I slightly disagree with, about nobody wants to buy treasuries. I mean, holdings among foreigners are still at record highs for U.S. treasuries. They're not buying as much, but they're still near the records for how much they hold. And the value of what they held has substantially declined due to the sell-off in the bond market. If you use the 2022 numbers, early 2022 numbers, they would be well above, like 30, 40% above their historic holdings from the prior record of treasuries, which is kind of stunning given the sell-off in the bond market. But the larger point is that people buy treasuries or hold treasuries as institutions for reasons other than investment. And I think a lot of retail participants look at it and they say, how do I maximize their returns? A lot of financial institutions, which serve as lenders to the world, they look at it and say, how do I shore up my balance sheet? And how do I maintain solvency? And that perspective, that subtle framing shift, is really critical to understand where the big pots of money are at. The big pots of money are in their eyes trying to be risk averse as opposed to maximizing their gain. And that's you made the point, well, they know they're going to get fewer dollars in the future. Well, their liabilities are dollars. So they don't really care if they're going to get fewer dollars as long as they can meet their liabilities with what treasuries provide to them. Eventually that will shift, but I think we're decades away.
All right. So Joe, real quick, would you say, is it fair to say that the liquidity that they're looking for, the rules that force them to follow this investment strategy, are they there to protect the underlying shareholders, the pension fund employees, the people that don't want to lose their money? And if so, is that actually work? That's my understanding. Keep getting calls. My understanding of why the rules are in place in the first place. Is that accurate to say that?
I think that's a huge part of it. The only thing I would add, which is really important, is keep in mind who writes the rules, right? If you are able to put in place a regulatory regime that forces you to hold government debt, I think that is huge. I mean, it's self-serving, right? It's kind of like, who would put in a rule that would say that high-quality liquid assets have to be, German bunds or U.S. treasuries? Because I think it's the government wants people to hold debt, right? It's pretty obvious and self-serving why they're doing that. And I think that's one of the reasons why I expect there to be significant pushback. I mean, you already saw it from some lawmakers that even if they approve the Bitcoin spot ETF, they don't want this stuff in retirement accounts. They'll lose, right? We know they're going to lose. We know how it ends, as they say in Bitcoin, but that doesn't mean it can't drag on for a very long time. And if you've got millions of retirees who have access to something other than government debt that is finite and has a much better everything. I mean, we can go on the list of how Bitcoin improves upon it. Don't you think there's going to be pushback to put a huge amount of people into Bitcoin from a retirement perspective? You're going to have major employers trying to stop it from happening. And by the way, it's the same reason why the majority of 401ks offer no access to gold, right? The gold ETF, the GLD and others have been around for a long time now. How many 401ks offer the participants, if they're not self-directed, access to gold? Like virtually none.
Yeah, I can add to everything that Joe said, and I do agree with what Joe said. And having a Bitcoin ETF will make it a little bit easier for people to invest in Bitcoin, but it still has to be a self-directed IRA person investing in Bitcoin. And I guess the best analogy I can give, think of Bitcoin kind of like a more volatile version of Tesla stock. So for a regular retiree, even Tesla stock is way too speculative, way too dangerous, way too volatile. Now, if you're a young person that actually, likes to drive a Tesla or did research on Tesla, and you are way more comfortable holding this volatile asset like Tesla stock. And Bitcoin is, even more volatile than that, even though the prospect of Bitcoin's volatility is to the upside. Just like the prospect of Tesla's volatility is to the upside, contrary to a lot of people's, debates otherwise. And there used to be someone that used to do very popular Twitter spaces. It was George Noble. I don't remember what happened to him, but he's like a big Goldman Sachs guy. He had a huge following. He's been a money manager for like 3 decades, very successful. And he had a rule in his spaces: we do not talk Tesla. Because he always thought that Tesla was basically hot garbage and never deserved to be a public company. And he's completely wrong, right? And he has 30 years of investing experience. Now, my opinion, he's completely wrong. The free markets, free market is telling him he's completely wrong. but he's sticking to his guns, right? Of 30 years of experience money management, that Tesla is like a fraudulent company, and it's not even allowed to be discussed in his spaces, which I haven't seen in a long time. So I'm not sure what the hell happened there.
Just to catch up, Tone, what happened to George Noble? George Noble launched an ETF. You can Google it, the NOPE, the NOPE ETF, which lost 98% since its inception and was forced to shutter a few months back. So that's the
Well,
that's what
I'm
happened
not
to George Noble.
surprised. I'm not surprised, right? Because like his views on Tesla tell me there is a major problem with all of his analysis. And while I was always, I was kind of high on Tesla, but I never done the research, right? I never did the company research. And one of my friends here in Panama, he's like, Tone, as much time as you spend on analyzing Bitcoin, I've spent equally as much time analyzing Tesla. And he's like, and I only hold two assets in my portfolio, Bitcoin and Tesla, right? Is like I outsource, Bitcoin research to guys like you, but I've done the Tesla research myself, and I'm comfortable holding like half my life savings in Tesla, right? Because he did do, a bunch of research. Now, again, is he going to be right or wrong? We don't know, right? But at least at least people have, looked into it. So think of it from the perspective of that person. If a person is too scared to put money in Tesla, they will, of course, be scared to put money in Bitcoin. Now, the way you put money in Tesla is by having a diversified portfolio, like even just the S&P 500. Buying into the S&P 500 gives you exposure to Tesla, but it doesn't really, hold your entire bag in Tesla. And this is where companies putting Bitcoin on their assets, on their balance sheets comes in. We don't need a bunch of people, investing in Bitcoin for their retirement. As long as companies like MicroStrategy see the advantage of Bitcoin. Bitcoin is already in the S&P 500. MicroStrategies. What happens when MicroStrategies is a top 5 asset in the S&P 500? What happens if Tesla decides to, go back to 40, 50, 60, 100,000 Bitcoin on their balance sheet, like on their books, like they did before? And when Bitcoin starts hitting their all-time high, a lot more companies that have the research arms to be more comfortable with Bitcoin, the companies will buy it. And then the average person doesn't need to invest in Bitcoin. He can, again, just invest in the S&P 500 and get all the exposure to Bitcoin that he needs.
Yeah, Tone, can I just add this? Because I hear this all the time, and it really, we're in the financial summit room here. And for people that don't understand what you just said, I think it's absolutely critical, because you get these doom and gloomers out there constantly saying the S&P is going to crash and go to zero and be worth nothing, and everybody's going to be unemployed. When I think that's the most stupid thing you could possibly say. If you understood how the S&P, the index, is created, it's a market cap index. So what that means for regular people, just in plain speak, it rebalances all the time, annually, right? You get a rebalancing based on market capitalization. So what that means is that, mega cap tech dominates the index right now. If in 5 years energy companies take off and you have a bull market in commodities, what do you think is going to make up the majority of the S&P 500? It will rebalance slowly over time to reflect a greater weighting towards energy, which I think energy stocks only are like 10% of the index right now. That could become 30 in the next 10 years. But the beauty of the Bogle strategy, the passive investment strategy, is that it actually reallocates for you, so you can go live your life and not have to worry about constantly buying the next winners. You buy the entire thing, and you will get the winners by virtue of holding the index.
Hey,
We
Joe,
have two hands up. Go on.
sorry, I got a question directly to what Joe just said. The rebalancing, since I didn't realize that happened, again, not being a financial guy, I'm not aware of all these little the dynamics, let's say. The rebalancing, is that done by some formula that becomes sort of automatic, or is that people making choices? That makes more sense. And is that then why the reason the S&P 500 is the place to invest if you have only one place? Because essentially, as it rebalances, it's always going to have profitable stuff near the top, and it should always sort of either outperform the market or be the performance of the market. Is that fair to say?
Yeah, in the long run, that's true. I mean, you can obviously have moments where people get scared, like the COVID thing, COVID lockdown, where everybody was pulling money and selling off. But in the long run, the S&P 500 is built to put money where it is being treated well. It's built to that's why everybody complains about, oh, it's 5 or 6 stocks. Those are the best 5 or 6 stocks you want to own. That's what makes up the index. That's why they make up half of it. And guess what? If you go back and look, Jim, like 20 years ago, what the top stocks were in the S&P 500, the vast majority of them are all gone. They've sort of, I mean, they're still in the index, but they're nowhere near as dominant as they were. They used to have, Tone probably remembers this. GE used to be one of the biggest companies in the S&P 500. It no longer is because of the fact that Apple and others have taken, captured more market share. So it's built to do exactly what you're saying. It's built to find the stocks that are performing the best, and it will reflect that from a market capitalization standpoint.
Oh yeah.
Also, Supper Jim, there are like multiple formulas that each index can use. Like S&P uses one, you can have equally weighted or not, like weighted on terms of other things. So yeah, there are multiple ways in which different indexes balance themselves after a certain interval of time. So
that was
going on
very helpful. Thank you, guys. Sorry, that was super helpful for a regular guy that doesn't know all this. I now have a brand new paradigm on the SP 500. Now, every time I hear the guy on the news talking about it, I can visualize it way different in a much more positive way, honestly. So thank you very much for that. That's not even why I had my hand up. So I'm going to put it back up and let Chris go.
Okay.
You're invested in a better asset, so don't worry about it. You'll still outperform it.
Yeah, let me just throw one more thing in there. So yeah, you can actually look up like on how often. I think it's once a year or something. The S&P rebalances. Like I don't even like really pay much attention to that. I know the day that it rebalances is generally like a day that everyone watches in the market. I don't know how often they do it, but it's not like
I
when
think
you
it's
ask
twice a year, Tone.
it could be twice a year, but when Jim said, is this like an automated formula or is it like a human element to it? And Joe immediately said it's an automated formula. I'm going to say it's a bit of a combination. It's not like it's Bitcoin, right? Like the Bitcoin halving is an automated formula, right? But when it comes to the S&P 500, it's a company. S&P is a company, and S&P maintains the index, and the company chooses which 500 companies, and it's also never 500. It's usually like 492, 493. So the company selects which 500 companies are in the index, but they do have, publicly available information that makes them choose which 500 companies. And yes, there will always be debates amongst, the people at the company. Okay, we need to kick this company out. We need to put, a nice startup in. And I'm sure that on the edges, that 498 company tends to be a bit debatable. So obviously, a human decides. But that last company going into the indexes does not make much of a difference, right? We are talking like 0.03.
I think I lost Tone.
Yeah, Tone,
with that
you cut
last
out,
bit.
but I'll just say I
Yep.
totally agree with you. The point is that like there is some minimal discretion, but I think if you're speaking just sort of more directly, like if you're not going to have a major company that's one of the biggest top 5 companies in the country that doesn't have exposure in the S&P 500, that's not going to exist if it's a publicly traded company.
Totally agree.
That's kind of the point.
Chris?
Am I back? Am I back?
Yeah, you're back, Tone.
Okay. Yeah, I was just saying, and also like it's it's not like a top 20 S&P companies get kicked out because they're based, right? Like, hey, we don't like their politics, let's kick Tesla out of the S&P 500. Like that's not going to happen.
Well, let's move on. Chris, you have a question?
Yeah, I do. I don't know whether you guys heard Jack. I think it was Jack Mallers on the news channel. I think it was CNN. I think it was today as well. But I've actually got it here. It's like 90 seconds, and I'd like to ask your view on it if you haven't heard it. Do you mind me playing it?
It's got what?
It's Strike CEO predicting the Bitcoin price is going to skyrocket.
Yeah, go ahead. Go ahead and play it, Chris. I've been meaning to listen to it, but I haven't gotten around to it yet.
Be my message to America. Give me a second on this one. Guys, the U.S. government's got about $10 trillion over the next 2 years to roll over, refinance. That's debt. Our country's in debt. It's a huge problem. They got 3 options. 1, they can pay it back. It's not a real option because we don't got the money. We're broke. 2, our government could come out, Charles, and say, you know what, guys, we screwed up. After World War II, we changed the way money worked. We got off the gold standard. We issued debt all over the place. We got way too cocky. And actually, all of our banks don't have your money. They're insolvent. All the airlines you fly and travel on aren't actually good businesses that should be in business. Healthcare shouldn't actually be free. We screwed up. We piled on so much debt and screwed up the younger generation, right, and we're in huge trouble. So we're going to have to let everything fail and reset this country. Now, they're not going to do that, are they, Charles? They have third option, which is unique to the government. They could print the money that they're missing. And when they print the money that they're missing, they're stealing from all the people that hold U.S. dollars. And so what they'll do, they'll have to do is print dollars. And the only way to save yourself is own not dollars. And that's when you see things like the S&P 500 and gold and Bitcoin soar. And so that's what's going to happen over the next 2 years. They got to print 3 times more than they did during COVID.
I love your enthusiasm, Jack. We're going to bring you back. We really do love.
Yeah, he didn't like the way he was going with that, but I thought it was quite prudent to the conversation at the moment. And I think, Joe, do you think potentially because of the amount of printing that they're going to have to do, back to your point about Bitcoin not soaring quite as high as you think, could we be underestimating that on the basis of what the government are going to have to do to keep paying back the debt and the interest on the debt?
Well, I think it's really easy to underestimate Bitcoin, and I think many people have lost a lot of money underestimating Bitcoin. But I mean, some of the things that Jack is saying there, which I respect the hell out of that guy. I don't want to say anything negative, but I just strongly disagree with. I don't think it makes a whole lot of sense. I don't expect them to be printing the money in the next 18, 24 months because the economy continues to remain robust. I think you're going to have higher interest rates, which will attract more capital, which is what was required, right? Like if you're going to finance the government at these levels, interest rates structurally have to probably go up. People are not going to fork over capital for 4%. You're probably going to be moving to 5s, and that'll be the norm. And by the way, this isn't something foreign to our history, right? You had a decade where interest rates were substantially higher than they are here. In fact, you could make an argument they're still too low to actually attract capital. So I think you do have a deficit problem. You do have structural long-end spending problems that are problematic. But, the $10 trillion number is just factually wrong. That's not accurate. The single greatest buyer of treasuries has been the Fed, right, over the last 10 years. So you have to acknowledge that as an issue. And the question becomes, how much of the money that is being used in funding treasuries can flow into Bitcoin? And I think because of the reason we talked about earlier, structural reasons, there is a limit on that in the near term. But I do, I'm bullish Bitcoin. I think Bitcoin is going to do extraordinarily well. I just think that the direct connection with the debt issue is sort of misleading.
Yeah, I want to jump in on this as well. So, look, Jack may very well be right and that Bitcoin is about to rise because, look, Bitcoin is entering a bull market. But Bitcoin is not going to rise because the U.S. government is printing trillions of dollars. And I agree with Joe. Jack's, is a little off on the facts. It's not going to be 10 trillion and that they're going to print. And yes, the U.S. government is going to roll over about $10 trillion in debt from short term to long term. And that's fine. They roll over this short term debt all the time. It happens all the time. You just don't see it. Maybe it's not 10 trillion. Maybe it's like 6 or 7 trillion over the next year or two. But yes, a lot of it's going to get rolled over, and a lot of it's going to get rolled over into a higher interest rate, which is a big problem for the U.S. government, but it's not a problem within the next 2 years. This is a cumulative problem. Now, I think this cumulative problem of 5-6% interest rates is going to completely crush the United States at the end of the decade, maybe 6 to 8 years away. So Jack's timeline is probably a little bit off. Also, the main reason why Bitcoin is going to go up is not because the U.S. government is in debt and is printing money. It's because of speculation into Bitcoin. When Bitcoin starts to go up and it starts hitting a new all-time high, FOMO sets in, and more people want to get into Bitcoin. Now, is the U.S. dollar eventually going to collapse and is no longer going to be the world reserve currency? Yes, of course. And that's probably coming sooner than later. But again, my timeline is approximately 6 to 8 years away. And this timeline is speeding up exponentially because 4 years ago, I had I wasn't sure what the hell would cause a big collapse of the US dollar at the end of the decade. I still had that timeline from some of the people that I trust and follow, but I didn't have a catalyst to do it. The catalysts have come in droves in the last 3 years since Biden took over office. We've had multiple catalysts because what causes the collapse of the world reserve currency and of the global superpower at the time, like the Roman Empire and the Greek Empire before that, and Amsterdam and all of them, is basically the collapse of confidence in that country maintaining global dominance. That collapse of confidence comes in three forms: political mistrust, economic mistrust, and military mistrust. Or in the case of military, basically military, collapse, or the United States military no longer being the world's strongest military. And we're witnessing the collapse on all three fronts. We're witnessing the loss of confidence in the US political system. We're witnessing the loss of confidence in the US economic and financial system, but it's not in the way that you think. Remember, you have to think global. We can't be, US centric here. The United States using the banking system as a weapon is what is causing a huge mistrust in the US economic system. Removing Russia from SWIFT, threatening sanctions on China, having sanctions on Iran for 2 decades now, and Iran has been able to survive through it. And now they're in a cooperation with China and Russia to where Iran could potentially be the next dominant country in that region besides Saudi Arabia. Saudi Arabia and the UAE and the Middle East, having the confidence to get out under the US grip of their financial system and joining the BRICS. This is the collapse of the US economic system. And it's easy to see the collapse of the US political system and its social structure. And we're witnessing the US's gross incompetence with their military. This is what's going to lead to the collapse of the US dollar, not the amount of money that the US government is going into debt. That mistake has been made time and time again. Gloom and doomers have been screaming about the dollar collapsing because the US government is printing too much money going on 20 years now, and the US dollar is only getting stronger versus, the rest of the fiat currencies. So, yes, Jack is right long term, but maybe not even exactly for the reasons he's right on, but he's certainly right on Bitcoin because I'm very bullish for this market over the next year and a half.
Just one follow up, guys. The U.S. debt to GDP is like right around 130%. Right? Japanese debt to GDP is about to overtake 300%. 300% debt to GDP. And if you think that the debt to GDP, the constant borrowing, the quote unquote money printer go burr that's going on in Japan by the BOJ, which is way more egregious than the Fed. I mean, they own pretty much the entire Japanese bond market. In Bitcoin terms, the yen is not even made. Bitcoin has not even made a new high against the yen. If you're calculating Bitcoin against yen, it hasn't even taken out the 2021 highs. So the notion that money printer go burr or government debt means Bitcoin explodes higher in the short term, I think Tony said it perfectly. It's not right.
Right, but and also keep in mind. So what was that? Real quick on the Japanese 300% debt to GDP. The US dollar is a lot more incentivized not to collapse than the Japanese yen. And the Japanese yen is still, ticking at 300% debt to GDP. So just keep that in mind as well.
Let's just go for Indonesian pesos as the global reserve currency. Much easier. Everyone will be a billionaire. All right. I think that was a great discussion. I want to basically move towards ETF now. And as we have our ETF expert in-house today, Joe, first of all, do you want to give an update on what's going on? What are we looking at? And I have one question which I've heard, I don't know if it's rumors or is it real, about SEC saying that they do not want Coinbase to be the custodian because they don't want an exchange to be a custodian. Is that true?
Or was that question for me?
Yes,
Yeah.
you are the ETF expert.
Oh, I'm sorry. I didn't. So the question is the custodian argument. So effectively, what we know at this point is that there were some concerns, at least, and again, I'll take this all with a grain of salt because we don't have direct information or some sort of direct announcement. It's always whispers, and it's folks that are supposedly close to the situation, mostly the guys at Bloomberg who are talking with some of the ETF sponsors. So what we do know about the ETF, just as a quick catch up for anybody, there was a window with which it was possible to open to approve applications this last week. The window closed. We're now back into a comment period, which it would be very strange if the SEC greenlit an ETF before the comment periods expire, and you have overlapping comment periods now going through the end of the year. So I think at this point we can say with high degree of confidence, very unlikely for there to be an approval in the next, anytime in 2023. You're kicking it until 2024. So put that aside. You have, I think, some suggestion that in terms of the creation of shares, the SEC is requesting cash creates rather than in kind, meaning that when they're going to create new shares for some of these entities, they want the sponsors to effectively have those who would buy the shares pay cash, and then they would go out and acquire the Bitcoin. That's different from folks coming in with Bitcoin, right, and then getting shares in the ETF vehicle. And the reason why that has been speculated to be the case is because they still have concerns about how the broker-dealers are going to actually hold the Bitcoin, whether there is an exchange that is regulatorily compliant to hold the Bitcoin. And what I've said for months, and I had in a space with Server Jim on this, is that the SEC currently is suing in court right now, saying Coinbase is not a registered exchange, is not lawfully able to operate as a broker-dealer, as a clearinghouse for crypto in general. Okay, that's their position. They said they've never properly registered. So the question is, would they approve a spot ETF where many of the applications are relying on an agreement between Coinbase and NASDAQ to effectively serve as their custodians and purchasers of Bitcoin to facilitate daily transactions? You can say yes, you can say no. I don't really care. My point is that there's an inconsistency there where the SEC is going to say we're going to allow this spot Bitcoin ETF to come to market if that's what you believe, and then you also have them saying the entities that are basically the backbone of their trading activity are not lawfully compliant.
Tone, any takes on that?
Sure. So I am going to say the same answer I've said for over a year now. And I've always been in a position that the SEC will not allow a spot Bitcoin ETF. Now, my view on it is a little bit cynical, but it has been consistent. Gary Gensler will not allow a Bitcoin spot ETF. The end. The only way Gary Gensler will allow a Bitcoin spot ETF if there is a backdoor deal that from the government, and if the government wants a Bitcoin ETF, I don't know if they do, okay? But if the government wants a Bitcoin ETF, they would have to bribe Gary Gensler with, say, the next Treasury Secretary position is him. And then he'll say, fine, I'll do whatever you guys want. I'll allow a Bitcoin ETF. Gary Gensler is not going to allow a Bitcoin ETF on his watch. I've said this many times. The reason for that is because Gary Gensler understands Bitcoin. And in a way, he might be the biggest Bitcoin maximalist out of us all. He doesn't want shitcoin ETFs. He will do anything to prevent shitcoin ETFs. And he knows that if a Bitcoin spot ETF is approved, he's going to get 8,000 applications across 8,000 shitcoins going all the way back to BitConnect as to why it should have a spot ETF on the market. It's something he doesn't want to deal with. It's something that he doesn't want his staff to deal with. And he will not be able to deny an Ethereum spot ETF if he approves a Bitcoin spot ETF. And he will do everything and anything to deny the Bitcoin spot ETF. I'm going to rephrase what I said on my YouTube channel last week. He will use the excuse that the dog literally ran into his office and ate the paper he was about to sign to approve the Bitcoin ETF. and they would love to print out a brand new paper for him to sign, but since the US government is broke, it will take another year to replace the printer at the SEC's office, okay? Now, what Joe just said about Coinbase not being able to be a custodian literally sounds like the dog ate the piece of paper excuse, okay? And if this doesn't work, he will come up with a crazier reason as to why the Bitcoin spot ETF will not be approved. Now, once Gary Gensler is removed and is replaced by a former executive at BlackRock, the ETF will immediately get approved and all will be well. But under Gary Gensler's watch, I will be the most surprised person in the world if we see a Bitcoin spot ETF. Oh, I wish Joe was still a speaker to comment on that.
Yeah, he went down. I've tried to invite him. I'm not sure. Maybe he's disconnected or something. Well, guys, if you have any other questions from the space, from the listeners, please put it in the comments, or you can request to come up and have a chat with us and put some light on what you think about the markets in any way, or if you feel you want to add to any of the topics that we have discussed, please feel free and request. So, Tone, moving on.
No,
Yeah, go on.
Jim's had his hand up. I don't know if you can see it or not, but I've seen it.
Oh, Jim, go on if you have a question.
I'm glad you said what you said, because my question goes way back, and it's sort of broad, using a specific example you guys brought up earlier on Tesla. But Tone, I do quickly want to say that was an interesting analysis that I hadn't heard yet on Gary Gensler. And before I get to the question, I want to ask, how long before Gensler's out of that position, do you think? Is there a timeline?
I think there is a timeline. I think the next president, no matter who it is, will probably look to replace Gary Gensler because the SEC has just been grossly incompetent, in my view. They completely screwed up the Ripple case. And look, the SEC is not supposed to be front and center on the news, but they seem to be. And Gary Gensler is like a celebrity running the SEC. The SEC needs to get back to having a non-celebrity running the division. So I do think that Gary Gensler's days as the SEC chair are kind of numbered, mostly because the SEC is in the news way more than the government wants it to be.
So I appreciate all that. So if it's appropriate, I wanted to ask a question about valuation. When you were talking about Tesla being volatile and being whether people can put it in a pension plan or whatnot, and plenty of discussion on that. It led me to think about how does the market value things these days? And my perspective over my lifetime is that companies were always valued on essentially their profitability and their ranking in the marketplace, and whether or not they're on the cutting edge of new stuff. All that gets priced into what their value is. It's certainly whether or not they're profitable. And it seems things have changed to where companies get valued for what they might do someday. You see rounds and rounds of VC funding for companies, especially things like shitcoins and what they promise, for products that never even show up or show up different or whatnot. And it's like the fundamentals are all broke. And I think about Tesla being one of those things that feels like much of their success has been around regulatory capture and this save the planet narrative of everything's going to be electric one day, when the likelihood is slim to none. And much of this is caused by government and not the free market, meaning, the ability to electrify everything is literally not within the capacity of all the production of the world right now when you add up all the batteries and infrastructure you need. It's a discussion I don't mean to get into, but as a point, it seems like Tesla's valuation might be beyond what it's actually going to bring to the market someday, unless it already has. I don't follow it close enough.
Jim, you're coming to this realization that some of us take for granted, actually. Once again, something I've talked about many times, and something I learned from reading people like Martin Armstrong like over a decade ago. Every single stock is the price of a stock is not what the company is doing today. It's what the company is expected to do multiple years down the line. No one cares. This is why it's like, oh, this stock is trading at like 8x price to earnings ratio, or like Amazon wasn't profitable for a decade, Facebook doesn't make any money. None of that matters. The stock market is speculator, is complete speculation. No one is investing in Bitcoin based on what it's worth right now. People hold Bitcoin based on what they think it'll be worth in the future, right? There is no reason why someone would buy a Bitcoin for $50,000 and continue to hold it through the bear market as it goes down to 15,000. Why are they holding it? They are holding it because they believe what Bitcoin will do 5-6 years down the line. It is no different than for any other company, whether it's Tesla, whether it's Facebook, or whether it's Kodak. Back when Joe was giving the example that GE was once the biggest, company in the S&P 500, the more interesting one to look at is the Dow Jones. The Dow Jones has been around for over 100 years. The Dow Jones is only 30 companies. It would be great if you took a little bit of time and just go back to the bubble of 1929 and which 30 companies were in the Dow Jones and how many of them remain today. It might actually be just one, GE, I think. I'm not sure, okay? I think there's only one company left in the Dow Jones that was around for the 1929 bubble, okay? And even in the 1980s, the biggest companies were literally Kodak and one more, like the photo companies were the biggest ones. Now they're gone, okay? So yes, companies go down in price because of future expectations. And the reason why Tesla was rallying several years ago so high is because of the expectation that everyone is going to be driving a Tesla, okay? So yes, that's exactly how the stock market behaves, just like Bitcoin.
So then it's fair to say that, so from my